Blake?
What's going on, man?
Oh, was on the beach drinking a hurricane and figured out I had to be here, so I had to stop that and come back here. I figured it was 5 o'clock somewhere.
Absolutely. That's what I'm going to be doing this evening, just not on the beach.
There you go. There you go.
Just probably out back out there. Maybe by the fire. I don't know.
There you go. There you go.
Kind of I was just telling everyone in the chat, like I woke up this morning and I tried to go trade, and I was trading some of the indices and the price action just wasn't there, and then I saw Tesla run, and I was like, you know what? We did good this week, so let's just wrap this up on a high note, call it a day.
Yeah, yeah, definitely. I mean, I've been playing, what is that, Sienna a little bit. It's been doing pretty good. It was kind of moving up, and today it kind of started selling off. I was just like, probably time to take a breather on it. So, but
Mhm.
just kind of hanging out a little bit today. But
Well, and it's interesting because the indices like the SPY and the QQQ are making all-time highs right now, but it's just like this slow grind, and
yeah,
sometimes that's hard to trade.
well, you have to understand something also. Monday is rollover in the index futures.
Mm-hmm.
So we're going to be moving from the September contract to the December contract. And there's literally a 54 point premium between the September and the December. So come Monday, the S&P is going to get marked up 54 points. And
Hmm.
so we'll be up above, well, right now, the December S&P, SZ 25, um, ought to be 66.54. Come on, pop in there. But yeah, so instead of 6,600, we'll be at 66, no, 55, 56. I don't know where we're going to be after the nighttime here, but anyway, we'll find out
Yeah.
where things are going to be come Monday.
Yeah. Sunday night, whenever they open up because isn't that well, they don't roll over well, that's different.
Well,
That's
the
futures.
cash doesn't do anything. And what happens, I mean, you have to remember these are futures prices, right?
Right.
So futures try to predict where something's going to be in the future.
Mm-hmm.
So in theory, and it is theory, that the September futures price that expires on expiration next week on Friday, and the cash price will be the exact same price because, well, the futures are trying to predict where the cash is going to be, therefore they have to be the exact same on expiration day, right?
That makes
So,
sense.
so just like an option, the further out from expiration you go, the higher the premium, right? So if I look at a January option, it's going to be a whole lot more expensive than an October option, just because of the time premium. Well, it's the
Right.
same thing in the futures. When we roll over to December, we're 3 months out from expiration now, to December. Well, the cash is still the cash, so they've marked it up time premium wise.
Ah,
And so that's not to say that the futures won't sell off over the next month. It's just that there's still going to be a big wide premium between the two of them until, I mean, you'll see it if you just put a quote page up or whatever and put the December futures and put the SPX on there. You'll see just week after week and month after month they get closer and they get closer and they get closer and they get closer to where they go to nothing. And that's just how it works out. Now, it doesn't, I mean, you can look at that if you want to. You can look at, the cash of, crude. You can look at the cash of, uh, crude oil or whatever it is, and it kind of does the exact same thing. The only weird thing about crude oil is it expires every month. So you don't have a whole lot of no difference between those two. A lot of times you'll have 15, 20 cents between the two contracts, and it's not all that much. But when you're looking at something that's going 3 months out, you usually get quite a bit on that.
yeah.
So, but anyway,
That's good. Well, that's good to know. I'm glad you explained that because I didn't realize that. I mean, I know they roll over like
hmm
the contracts, but I didn't
right.
think about the fact that they have to price them up because it's the futures.
Yeah. Yeah. And well, and they don't necessarily have to price them up necessarily. Sometimes we're at a discount. If you go, Back to 2009 up to about 2016, 2017, we were actually on a discount of the future. So like the September S&P right now is 6,600. Then what would happen, you'd see the December contract at maybe 65.50. So they actually had it at a discount. And it's not I'm going to say it's not unusual to see a discount, but it's at a premium more often than it's at a discount.
Uh,
Even though you had a bullish market during that time period, which you did, you were still at a discount because the belief was the economy wasn't going to be as strong as it should be. And so they were, saying we're probably going to be further down into the future as opposed that's pessimism, right? As opposed
mm-hmm.
to optimism, which we're going to be up into the future. So, and you can see that a lot of times in those futures markets just to see what, if there's pessimism and optimism. But you also have to remember we had interest rates at zero for what, 10 years. So
Yeah.
and if the longer they kept interest rates that low, then the economy wasn't expanding. Because if the economy was expanding, we'd have inflation. They'd be no raising rates, like we saw 2 years ago. They started raising rates because inflation was going crazy. And so we weren't ever having that. So we were basically in stagflation and we weren't
Mm-hmm.
going anywhere. And so the futures were just like, well, we're stagnant. We're not going to be growing at a whole lot. So therefore, and it was kind of weird. You'd see a discount of like 7 points between the two contracts and it was 3 months apart. And you're just like, well, 7 points is nothing. I
Yeah,
mean, I
that's
mean, the SPX can move 7 points in, a blink of an eye.
yes, it can.
So, and so that's the thing that you run into a lot of times, and that's why I like watching the when we're getting closer to rollover. I always like to start watching the other contract just to see how much of a premium or how much of a discount. And it's kind of interesting on rollover day. They'll they a lot of times try to what's the best way of putting it? Try to equal things out a little bit.
Mm-hmm.
The traders out there are so used to, they on Friday, here's Friday today. Here we are
Here.
at 6,600 on the S&P. Come, Monday, we're at 66.58. Well, they've never seen 66.58 before, right?
Yeah.
And so that's the problem. And I can basically, share my screen here a little bit, I guess.
That's what I was gonna say. I was booting up Thinkorswim. I was like, I gotta pull
Yeah.
these charts up here.
But but yeah, I mean, you'll get here, dollar sign SPX. And let's grab um S&P here.
Oh, let's take a look at this. What trading platform is this? Is this Roadmap?
Let's start roadmap software, yeah.
Oh, that's cool. I like this.
So what you have right here, you got the SPX on the left side and you got the futures on the right side, right? And you'll notice that the SPX here is trading at 65.97.
Mm-hmm.
Well, we're at 66.02. So we're 5 points apart in the SPX and the well, we got 1 week left to expiration. So they're basically going to be the exact same price in 1 week. I mean, they just have to be that way.
Has to be.
So what happens though is when you go over to the December S&P here, it's at 66.58. Well, now you're going to have a huge difference between the SPX because we're at 65.98 and we're going to be up at 66.58. Now we're going to have this huge disparity between the cash and the futures. But as time goes on, they'll get closer and closer and closer and closer. And in fact, you can actually make your own defined symbols in here. And you can actually see, do I have it in here? Tell me I do. Tell me I do. Uh, I don't see it in here. Hold on. Launch define symbols. Um, ESSPX. There we go.
So you have like the comparison pulled up already.
Yeah.
Would this also be called arbitrage? Or
There
is
we
that
go.
something completely
So
different?
there we go. See that ESSPX on the bottom of that page? Right
Yeah.
now we're 4.63 points, right? But if I change that over, uh, change this over, where is that thing? ESSPX, XPX. I just saw it. There it is. I changed this over to the December contract. Save. Let that thing update.
Yeah.
Get another trade out of it. You're going to see that thing jump to 61 points now. And now you can start watching that correlation between the two of them and say, okay, right now we're going to be 61 points. And as time goes on, that would deteriorate down to, well, we're at no 4 points right now. So it'll continue to deteriorate between there. So there is going to be a disparity. But sometimes you'll see on like rollover day that the December contract will have a down day since we're at a premium to try to get back to where the September contract kind of was, so because they're used to those numbers. And it's kind of a game they play. And outside of that, um, a lot of time, I mean, you'll see sometimes if we go up and make a new all-time high, right? Well, which contract's making the all-time high? That's the thing you get into next week. Because if we make a new all-time high on the September contract, well, the December S&P is making a new all-time high too. So, so
Oh.
you get into that rolling and climbing between the two contracts, and until you get past next Friday, the question is who's made the all-time high here? So once we get past expiration on Friday, then they only have one contract to work with, and now they can make new all-time highs, or they can start selling it off, or whatever it may be. But there's a fight between the two of them of who's in charge now, because the volume's going to shift to the December contract. That's where the traders are going to be. And you're going to have some people who are still trading the September contract just because they're arbitraging or whatever it may be. But now you don't have that anymore. And so now you've got a battle between the two contracts once they roll it, just the volume.
Mm-hmm.
And then once we get past Friday, then that September contract's gone and poof, you're on the December contract now. And now you're sitting there going, okay, now we really got to figure out if this thing's going to go up or go down. And you run into the same thing with the NASDAQ and the Dow and the Russell and everything else.
Any
And
indice that's got futures, right? Like you'll have
yeah,
the same issue.
Uh, Yeah. Well, and that's the thing. You if you open up like a just a chart. And in fact, let's try. What's a good one here? Here, let me just open up a chart here. Let's do this.
Dude,
ZSX5. See if I can get it to work on this.
is that soybeans?
Yeah, it is. Um,
I love me some beans.
so that's not working too well. Let's try. Uh, let's try GF V5. I think it's on V or is it on X? No, it's not really doing it all that much. But a lot of times you'll see big gaps in these charts.
Mm-hmm.
And the only reason why is you're going between the futures contracts. And that's one thing that you'll run into here. Let's just look at this real quick. New chart.
I know exactly what you're talking about because I've pulled up my charts before and seen a giant gap, like on ES, for example. And I've
Yeah,
been like, what
exactly.
the heck is that gap there for?
Yeah.
And my
But
buddy
it's,
would be like, oh, it's rollover.
yeah. Well, and this is U and G right here. And a lot of times you'll see gaps like right over in here. Here's a gap, and you got a gap right in here, and there's a gap up there before it, and you got these weird gaps in here sometimes. And
Yeah.
what happens is with UNG is an ETN. It is not an ETF. And an ETN is an exchange traded note. And why they use the exchange traded notes is because they do everything based off of futures contracts. And so they'll be long the near month and short like two of the next month out or whatever it may be. But when that one contract expires and goes away, now you're on the next contract. Well, is there a premium or a discount between those two contracts? And you'll see UNG, you might be making a ton of money on UNG, and all of a sudden it just gaps down. And you're just like, whoa, what happened? I just lost $2 on UNG. Well, that's because they rolled the contracts. And
Yeah.
that's the problem that you're going to run into on trading ETNs is when they start rolling those contracts over, it's not really good because you could be at a huge discount or basically at a huge surplus. So you
Right.
have to really, really be careful of that on those ETNs. So, but anyway,
And
but
I
yeah, I mean that's just what you're going to be running into really in the next week. And not only that, of course, we got good old retail sales Monday on the same thing, but we also have the Fed next Friday. I mean on Wednesday of next week.
We
So
do. They've got the rate decision.
yeah, and I mean odds are they're going to cut a quarter point. I think what they're really going to be hanging on though is basically what they say. And so based off what they're talking about, on that, at their little press conference or whatever it's going to be, is probably what the market's really going to react to. Just
Exactly.
because, they want to know what they're going to be looking at in the future. Are they still looking to make another rate cut, in October or in December? So we get two rate cuts this year, or we get no rate cuts this year. I
Right.
mean, I mean,
Yeah.
that's what they're really going to be hanging on, I think. And
Yeah. The
so,
guidance.
yeah, exactly. It's the guidance, and I think that's what the market's really waiting for is, yeah, they know they're going to cut a quarter point. Got that part, but what's he going to say during the press conference? And I think
Exactly.
that's when you're going to see the market moving is, not between, 2 and 2:30, but between 2:30 and 3 during the press conference.
Yep.
And
Yep. Yep.
that one's probably going to move the market a whole lot more. The market will still react a little bit off of, here's the, rate cut or whatever it may be. I mean, I get that part, but I think they're really going to be wanting to see exactly what the dude says at the time.
Yeah. Well, and the way I love to trade Jerome Powell too, and I won't really be able to like consider this now. We kind of have to wait until the day before to see where the market's at. But traditionally, what I see with Jerome Powell is the market creates these pools of high volume liquidity.
Hmm.
And initially, what'll happen is the rate decision will come out and the market will go for one of those pools of liquidity. And then when Jerome Powell starts talking, they usually go for the other one. It's like
Right.
I watch it every time and it happens just that way. That's why you can't ever trust the first move, but that second move is usually the direction the market's going in.
Yeah. Well, and that's another thing that people don't realize. And it's not something that, I mean, the traders out there do it, but it's not one of those things that you'll hear, on Wall Street or anything like that. I mean, Wall Street, if you listen to, CNBC or Fox Business or all any of those, business places, they don't believe that the market is basically can be manipulated or anything like that. The thing is, it's done by traders, and traders look at different things. Um, and when you start looking at how markets actually trade, um, what people don't realize is if you go back in history, if you go to the New York Stock Exchange back in history, all trades, I mean, they would trade and trade and trade. Remember, we didn't have computers and stuff like that up until really into the 90s and into the 2000s and stuff like that.
Yeah,
They had some computers in the 80s, but it was just kind of at the very beginning of things. And so what traders would do on the exchange is they would trade and trade and trade, but they were required every half hour to have all their trades turned in, period.
really.
And so every half hour they had to have all their trades put in. So they're not pocketing anything. You can't just hold it all day and then put it in at the very end of the day, right? So they
Right.
made them that was an exchange rule. You had to turn it in every 30 minutes. So really a 30-minute chart is the most important chart you can have because all the trades are turned in by then. And so you'll see a lot of people will look at 30-minute charts, and that's the reason why, is because they have to have all their trades turned in. And another thing is you'll see the market defend opens. You won't see them defend closes. You'll see them defend opens. And the reason for that is you look at a close. I mean, they always quote the close. I mean, the market closed here, the market closed here, the market
Yeah.
closed here. Well, who cares where it closed? Can you go back to yesterday and trade? No, I wish I could. I'd love to be able to do that. And I don't think anybody buys a football ticket to get there in the last 30 seconds of the game and go, yeah, well, we're done. I can leave now, right? Nobody does that. And it's the
No.
same thing. I can't start the race at the end. I have to start the race at the beginning. And that's when you get the ding, ding, ding. Who cares what yesterday did? Now we got to trade today. And so if you were watching like the SPY or the QQQ this morning, they moved down, but they kept running back to the open and failing. And finally, they got above that open and they took back off just because that's the line in the sand. And not only that, but when you start looking at just the opens of anything, I mean, you can look at 5 minute bars and you can look at, hour bars or whatever you want to, but those opens is what they're going to defend. And you'll notice on these little boxes you see on these charts is that you'll see week open and month open and year open and all those opens that are on here. And the reason for that is that's the beginning of the race. So we here don't look at, where'd we close yesterday? Well, who cares? Where'd we open today?
Yeah.
I mean,
Who cares?
yeah. I mean, I can't do anything about yesterday. But one thing that yesterday gives us is what? It gives us highs and lows. This is the highest the traders could take it. This is the lowest the traders could take it. And so we can use those highs and lows for support and resistance and all that. But we can still use the opens and say, here's where they opened up. If we close above open, what? The Bulls won. If we close below open, the Bears won. Now, the question is now is our open today lower than yesterday's close? Right? Because what happens is like earnings. Let's just use that. That's a really good example. Let's
That's a
use,
great
I don't
example.
know, Tesla's earnings, whatever. So, and let's just say good old Tesla. We'll throw Tesla in here. TSLA. There we go. So let's just say good old Tesla here is trading at 392. There we go. And let's say their earnings are coming out tonight. And we're trading at 392 right now. So if they come out and their earnings, let's say they're bad, and they open up down here at 347 the next day. Now,
Mm-hmm.
they gapped it down overnight big time, right? They lost 50 bucks, 40 bucks, whatever it may be. Well, from open, they could rally that market all the way back up to 385 and have a huge up move during the day, but still be below the previous day's close, right?
Yeah.
But if you shorted the thing at the open, how'd you do?
Not
You got
great.
you got hammered, right?
You got
You got
slaughtered.
hammered. But what they'll say on the news that night is Tesla was down because they had bad earnings. Now, whoa, hold on a second. It rallied $35 from the open today. How do you say it's down? Because they're going from the previous day's close. And that's
Right.
what happens. And
Yeah.
so you have to be very careful about what they say on TV is saying, "Oh, is that true?" Because it might not be because they
Mm-hmm.
do it from the previous day's close. So as traders, I don't care about, the previous day's close. Now, if I'm somebody who owns, let's just say we bought Tesla back when it was 250 bucks, right? And I still own it and I've been holding the shares forever and 4 days. And from yesterday, I'm down, 10 bucks. Well, yeah, I'm down on my position from one day to the next. That part I get. I can sit there and start gauging it. Well, we closed at 392. We're here at 380 after the close today. So I lost $12 today on my so I'm down 1,200 bucks on my 100 shares, right? But for the person who bought it down at 350 and they got out at 380, they're over there doing a nice little dance and they're heading to the beach for a nice little umbrella drink.
That's
So
right.
and but that's the different point of view when you're looking at am I a trader or am I someone who just buys and hold things. So but you do have to be very careful on those gaps and stuff. And that's why what the futures are so nice about because you look at, like, the SPY. Here we go. You look at the SPY, and here's a good old daily chart of the SPY. You have these gap downs and gap ups and gap downs and stuff like that. That's a weird tick on that thing.
Is that a wick?
Yeah, it's a bad tick. There we go. Anyway, but you'll see these gap downs and these gap ups and gap downs just because it doesn't show you what happened overnight. And this is what this is kind of a funny thing that people don't realize. So we open up at 9:30, we close out at 4 o'clock. You go ding 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 to the ding ding ding, right? And you
Mm-hmm.
have 6.5 hours of market. Okay. Well, in an hour from that close at 4 o'clock, 4 o'clock, We have one more hour of trading in the futures till 5. You get an hour break, and then at 6 o'clock we start the next day. 6 o'clock Eastern time is ding 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 time across the international date line. They're just waking up for tomorrow, and they're going to start trading this market. So as we're going to bed or eating dinner, they're opening up over there. In fact, New Zealand's the first market to ever open up. And then you go
That's
to
good to know.
Australia and Japan, and you go to Hong Kong and Shanghai and go on from there.
You go to
So,
London.
yeah. So as time goes on or the sun goes around the world, and I know the world spins, don't get me wrong here. But but as the sun goes around the world, we're getting these new opens of other markets and closes of other markets. Well, just because we close the previous day and open up the next morning doesn't mean that they're not trading our Apple and IBM and Disney on foreign exchanges. And in fact, you can watch Bloomberg in the morning if you have Bloomberg TV, and you can watch our stocks trading in Europe in the morning.
Yeah.
You can. There's a little ticker going across the bottom, and they'll show you all the trades that are going on in Europe on Apple and Amazon and all those stocks. Well,
Yeah.
that's part of the S&P and part of the Nasdaq.
It
So
is.
those indexes are actually moving. But the problem is that New York hadn't gone click and turned on the little index and say you need to calculate why those things are over there trading. They don't do that. So the cash index will only calculate when we're open here in the United States. So you're going to get these gaps up and gaps down. Those gaps actually are not real. They're not because the world traded it that way.
Yeah.
That's what happened.
Yeah.
And that's why the futures are so nice because they trade 24 hours a day and you can see
Mm-hmm.
what the world has done to our index. So even though we might gap up in the SPY, we can see the whole move in the S&P futures. And that's what's
That's
nice
right.
about the futures. Not to say that you ought to be, watching the futures and trading the futures and all that good stuff. I mean, you don't have to, but you can go to like bar chart or go to, I don't know, investing.com or whatever you want to, Yahoo even. I don't think Yahoo does futures,
I
but
don't
bar
think
chart
it
does.
does.
And you
Yeah,
can actually
Barcher.
watch to see what those futures are actually doing. And you can see how your stocks are doing just by watching the futures. Well, they're down. I don't know why Europe sold it off so hard, but that's what you can do with them. That's what's so nice about them is
I love
by
them.
the time we get to the ding 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 here in the United States, we literally have a world of information in the markets to,
Yeah,
to start trading with.
we do. We've got what London, where before that we've got the Asian session
That's
range, we've got
right.
the London session range,
That's right.
and
Yeah.
we've got midnight open, which I
Yeah.
think is a huge level too.
Oh yeah.
So
Well, what they don't realize is that well, really about 11 to midnight, right in there, Asia shuts down for lunch.
yes,
And and what's weird about Asia going to lunch, unlike the United States, because we're workaholics, they literally shut their market down. They literally turn off all the computers and all the lights. Everybody goes to lunch. And then when they get back, they go click, turn it back on, and off they go. So during that time period, they don't have their markets open, period. And we do. We trade the whole 6.5 hours. They don't.
yeah.
And so they shut their market down and then they open it back up and off they go. Well, by the time they get back from lunch, they have about an hour before Europe opens. And when Europe opens, Japan closes. And an hour after Europe opens, Hong Kong closes. And then you only have the European markets.
Mm-hmm.
So really from about 4:30 in the morning Eastern on, you only have the European markets open and trading. And of course, at 9:30
Exactly.
we open, and so we're trading with Europe our first 2 hours. And
We
after
are.
our 2 hours, they shut down. And then it's just the Americas. So you do have a lot of influence in the markets, and that's why you have a lot more volatility in the mornings in our markets than we do in the afternoons. Not just because everybody's tired in the afternoon, everybody has a lot of energy in the morning, but you have two sections of the world trading in our markets in the
At the
morning
same time.
at the
So
same
when
time.
the markets are going crazy at the open,
That's right.
it's
That's right.
benefited also by the London market as
Yeah.
well. And they've been
So
sitting there waiting for our markets to open to get some more
correct.
volume.
That's right. And so you get a lot of volume in the morning because you have those two sections of the world. After 11:30, it's just North Central South America open. And we end the 24-hour clock. We end the week. I mean, today's Friday, right? So
Yeah,
we'll actually end that 24-hour clock or the whole week. We're the last market to close around the world. Now,
we
and
are.
here's the interesting thing. So they influence us as much as we influence them. So if we have a huge up day, now how many times have you seen the market like really rally into the close or really dump off into the close? You've seen that quite often, right?
I have
So
all the
right.
time.
Well, that's what happens when Asia opens, and they're not opening up tonight, of course, because it's Friday.
Yeah.
But let's just say if it was no Tuesday or Monday or whatever it is, if we had that big rally into the close, we're going to mark them up because all the stocks got marked up while they were closed. There's their gap, right? Just like we have gaps, there's
Uh-huh.
their gap. So they'll mark them up. And then, but the same thing, we might rally into the close. The Asian and European markets might sell off. And when we come in the next day, we'll gap down because they sold off from our rally. And what's really funny, and I always think it's hilarious, if we have one, if the European and Asian markets sell off and we gap down, a lot of times when we go ding ding ding, they will take our market and rally it right back to the previous day's close. Here we go, right?
Yeah,
Because that's where we left our S&P. The world doesn't control our S&P. We control our S&P. How dare them take our S&P down? So
that's
you'll
right.
see that thing go right back to the previous day's close, and it'll flip right back around and sell off and go, now we can sell it off because it's our S&P.
That's
And you'll
right.
see that happen a lot of times. You'll
That's
see
good
us,
information.
yeah, you'll see it go right back to where we had it, and they go, now we'll sell it off if you want it sold off, and they'll flip it back around and they'll sell it off. I mean, the U.S. people are very egotistical, and when the
Yes, we
traders come
are.
along, they're really, this is our S&P, this is our Nasdaq. We'll do what we want to. You all don't mess with us. I mean, that's exactly how they are. And
That's
so
right.
that you'll see that a lot of times. You'll see them take it right back to the previous day's close, flip it back around, and go, now we'll sell it off. We're good.
We're good.
And it was just them proving to the world that you don't mess with us. That's
That's right.
basically what it is.
Yeah.
So
Last time people touched our boats, look what happened.
that's right, exactly.
So don't touch our markets here. Greg has a
Uh,
good question here. He wants to know if there's a London fix for the price of gold and if there's a similarity with crude.
well, now hold on. Yeah, I know what the
Timeout.
guy's talking about. I mean, you'll get that in not only gold, Greg, but you'll also get that in coffee and in cocoa also. Just because, and even copper. Copper's a big one too.
Copper
Um,
moved nice today.
yeah, but and what they'll do is at night, they actually do fix the price of gold. And but they're doing the cash market. That's what they're doing. That's cash copper, that's cash coffee, that's cash cocoa, that's cash crude oil. And it's not necessarily crude there, but they do have those cash fixes, and they do Brent there, not West Texas Intermediate. We do West Texas Intermediate. That's our crude oil contract. They do
Hmm.
Brent. So if you want to see the crude fix, look at Brent. All right. So
Brent oil. Is that
what's
like,
that?
what's Brent?
Brent is it's the deep sea oil and stuff like that. We have light sweet
Oh,
intermediate crude here. You can make gasolines and crude oil. I mean, you can make all kinds of stuff out of both of them. Brent is actually better used for like making tires and stuff like
oh,
that. And
interesting.
but you can still make gasoline and diesel and everything like that out of it. It's just that ours is a lot like a lot sweeter and it's a lot lighter and it's easier to make those distillates out of.
Gotcha.
Another thing that we have here is what we call sour. There's a lot of, I mean, sulfur in it,
Mm-hmm.
which can make sulfuric acid, and that sulfuric acid can eat things up big time. There was a lot of pipelines that I used to build and compressors and engines and stuff like that. That when we
Mm-hmm.
moved sour gas, we had to make everything out of stainless steel. And you talk about expensive. I mean, how would you like
Yeah.
to have a stainless steel engine? Well, that's basically what you had to have
Holy cow.
because the sour gas would just eat it alive if you
Eat it
didn't.
alive.
Oh yeah, because most of them are made out of cast iron, and so that sulfuric acid just eat them up.
Eat
So
them up. Yeah.
yeah. So, and that's
Interesting.
the big thing. So, but there are different grades of crude oil depending on where you pull it out of the ground and stuff like that. Some of it's a lot lighter, some of it's a lot heavier. Some of it's and when I talk about that, I'm talking about viscosity. I mean, some of it,
Yeah,
pours like, frozen molasses, and some of it, pours like water.
right.
It all depends on where you're pulling it from and what grade it is and all that stuff. I'm not a petroleum engineer or a geologist. I'm just telling you that's what I understand about it all. I mean, I'm more
That's
of a
really cool.
gas person than I am a oil person. So,
Yeah.
but anyway, that's the thing. And
You like trading natural gas? NG,
man,
right? That's natural
if you
gas?
trade natural gas, I mean, you've got bigger gut than I've got.
Yeah.
I mean, the problem with the natural gas contract, it's $10,000 for every dollar moved. Okay,
What?
it is that's the problem with it. So if you get a 20
Wow.
cent move, well, that's 2 grand. And so, and they don't have a mini natural gas contract. So you're trading the natural gas. People, I mean, people don't trade natural gas contracts. Um, unless, no, you're real big. I have traded natural gas. I don't know if you remember back in, when was that? 2012, 13, 14, 12, in there somewhere. Somebody up in the Northeast accidentally dropped a toaster into the bathtub and it shut down like, Pennsylvania and Ohio and, part of, Indiana or whatever it was in that area. I mean, they just had all of a sudden, poof, power went out.
No. Okay.
And, and when I saw that, I flipped around and I bought a natural gas contract. It was trading at like $2.85. So I
Mm-hmm.
bought a natural gas contract thinking, man, this thing's going to pop up. Well, the next day it was trading up at $3.30. And I was just like, oh, cool, look at that. I'm up like 40 cents on this thing. That's awesome. I thought, uh, so how much am I making on 40 cent move here? So I went and
Yeah.
looked up the contract. I'm up like 4 grand. And I'm like, on one I was like, oh my God. And I immediately bailed that thing because when I got in, I just flipped around and put a stop, about 30,
Yeah.
40 cents back and thought, what the heck? I'll see what this
Right.
thing does. Well, I was controlling 10,000 bucks and I was just like, wow. And after that shock, I didn't do that anymore. And it's
Yeah.
just like the silver contract. The silver contract is 5,000 ounces. So, I mean, you're talking 5 grand for every dollar silver moves. So, I mean, that's a pretty big deal. Now, they have a mini silver contract that only controls 1,000, which is cool, but
Mm-hmm.
it's a lot better than 5,000.
Yeah. Oh my
And
gosh.
yeah,
Imagine if that went against you.
well,
Woo.
and I used to trade a lot of silver. I mean, I have traded a lot of silver contracts. But I mean, but it'll give you a haircut if you're wrong. I mean, you talk about a mistake. I'll tell you one of my biggest mistakes I made. So when you look at a futures contract and you're trading options, options work just like, options in stocks or whatever. Then there's no difference. The problem is, and this is what really messes people up, you're controlling one futures contract with the option, not 100 shares, just one futures contract. So you have to look at the price per point of the underlier. And here, let me show you this real quickly. So here is slash do.
This is
Uh,
good stuff, by the way. I love this.
yeah. So this is silver, and let's just go look at an option that expires in 13 days here. Okay. So you're looking at these at the money things here. If you just do a little bit out of money, I mean, this is a 64 cent option. I mean, look at that. Here's a dollar option. It's in the money, right? Well, the problem is how much is silver per dollar moved? $5,000, right? Because it's 5,000 ounces. So an at the money option is 80 cents. That's 8 grand. I'm not 8 grand, sorry. That's $4,000 for that. So you got to pay almost, you got to pay 4,000, over $4,000 for that option. And it's an
Holy
80,
cow.
Yeah. So people think, well, it's a cheap option. Well, no, it's not. You're controlling 5,000 ounces. And so the thing is they always have to go out and look at first notice dates. And because at first notice date is when you can be assigned that futures contract, right?
That's what I was gonna say. Better hope you don't get assigned or exercised on
Well,
that one, because
so what they do with these options, they'll expire these options out about a week before first notice date. Because if you get assigned the contract, you have to have time to get out of it if you want to get out of it. So they do that. All right. There's only one contract that doesn't do that, and I'll show you that here in a second. So anyway, so they'll give it to you about a week out. Well, it was March, and my brain got to thinking, hey, I'll just do myself a monthly option because they have monthly options. You'll notice here's October, November, December, right? So I called the desk. We didn't have electronic trading platforms back then. I picked up the phone, I called the pit, and
yeah.
I said, hey, buy me one March option at 29 cents. And this is when silver was trading up at 43, 44 bucks. This is back in 2013 when they were making those highs. It just came off of $50.
Mm-hmm.
So I called the pit and I bought a 42 and a half call. And I said, it's at 29 cents. And the guy comes back and he says, it's quoted at 290. And I was just like, no, it says 29 cents on my screen. He goes,
Yeah.
well, I got 290. I said, buy the call. And he goes, fine. So I bought that call. Anyway, every night you would get a run, or you get your positions emailed to you every night.
Yeah.
And so that evening, I got my run, and I was going down through there. And no, actually, I sold that. It was a put that I sold. I sold the 42 and a half puts. What I did because I wanted to get assigned on the thing. Anyway, I sold that thing. When I looked at it, I had brought in $14,000.
Holy cow.
And I looked at that and I was like, how did I bring in 14 grand when that thing's at 29 cents? I mean, that should have been like, no, somewhere around
I was
$1,500,
gonna
something
say
like
it
that.
should be
Yeah.
like $1,400.
Yeah. And I'm just like, how is this thing 14,000? Well, then it all of a sudden dawned on me. The March contract expired at the end of February. I should have done a April contract that hadn't expired yet. So the March had already expired. I was looking at the expired contract price. So when
Oh.
I did March, he gave me a March contract for next year.
Oh my gosh.
So
That's why he said they're at 290.
I sold a 42 and a half put expiring next year in silver and brought in 14 grand. I was just like, I've got to get out of this thing.
I'm
So I
out.
thought, well, you
Yep.
know what? I'll just see what it looks like in the morning. So I get up in the morning, and what happened? Silver sold off, of course.
Oh no.
It dropped like over $1 at night.
Oh
And I was like, well,
no.
you got to be kidding me. So I pick up the phone and I called the pit and I bailed the thing. Same guy answers the phone. And
Same guy.
I bought the thing back and I was like, man, you killed me. He starts laughing. He goes, you told me to sell you a March 42 and a half put. And I said, I did. He goes, the only March was available was next year's. And I was just like, yeah, but you should have said, hey, you realize that's next year's? And he goes, yeah, but he goes, that's your responsibility. I was like, it is. It is. I said,
Oh
but
my
you could have helped
gosh.
a friend a little bit here,
He
right?
could have. He
Yeah.
definitely could have been like, that's a year-long time right there, Geof. But instead he's like, okay,
Yeah. So, but
if that's what
anyway,
you want.
so I lost $3,500 overnight on that thing.
Oh man, after
And
being up 14 grand.
well, yeah, I mean, I
Oh
brought in a credit of
man.
14. When I got out of it, it was like at 18 or whatever it was. It was awful.
Oh man.
So,
Well, you learn though from that. You're
oh,
like,
I
well,
definitely learned. Don't get me wrong. I learned that real fast.
yeah,
But yeah, it can, but you do have to be aware of, when you look at an option on futures is, what's it actually controlling? It's just like crude oil. Crude oil, you're controlling 1,000 barrels, right? Well,
right.
when you look at crude, here's good old /CL.
Love this one. It's not sarcasm. I do love crude oil.
But they got no dailies here and anything like that. But here's 3 days out, whatever. But
Monday's
same thing.
contracts.
You're looking at something here that's 47 cents.
Those are
Okay,
cheap.
well, yeah, but 47 cents is $470. It's not $47. Remember, this is $1,000 per point.
That's the underlying.
So you're this is a $400 option.
Oh my gosh.
And so people don't realize that. The only thing that works is just like stocks is good old gold.
Really?
Gold, you're controlling 100 ounces of gold, just like 100 shares of stock, right? So whatever you're paying for the option is times 100. So gold works the exact same thing as an option on Tesla or whatever it is. You're controlling 100 shares, you multiply it times 100. That's why these are expensive looking because, hey, you know, you're paying 1,700 bucks for that at the money call right there.
Holy
So,
cow.
but yeah, you're just controlling one contract. And a lot of people run from this because it's totally different than the way they were taught on options. It's 100
Right.
shares, it's 100 shares, it's 100 shares. With
Yeah.
futures, it's not. It's just the price per point of the underlier. So that's just what you have to learn on that. And gold works just the same. Anything else doesn't. Everything else goes, 1,000 ounces. I mean, all the grains you're controlling 5,000 bushels. So everything's times, no, it's 50 if you want to look at that. So you got to do it times $50. So, I mean, but you just have to learn that, or you can go to the CME and just say, how much is this per point?
Yeah,
And
you got to look it up.
yeah, and it'll tell you. So,
That's so interesting. I never knew that about the commodities futures like that, like
yeah.
gold, silver. So you
So,
really got to be like before you place one of these trades, you got to know what you're doing.
yeah. I mean, that's true, and that's why the gurus everywhere they don't do futures because people get totally lost when you
Yeah,
get to the options on futures, and they work the exact same way. I mean, you think
they
about it,
do.
this is a $5 wide spread here. This is by a vertical here. A $5 wide spread's at 210. I mean, they work virtually the exact same way as a stock. But the thing is, that 220 is 220 bucks. So I can buy a $5 wide spread for $220. If I pick up $5, I get $500. So that works great on gold. But anything else, it doesn't work that way on, just because it's per no point of the underlier.
Yeah. Well, and
So,
that bid ask spread looks pretty wide too when you just
well,
did that.
yeah, I mean, I mean, you got 60 cents here, 50 cents bid ask.
Yeah. That's a
So,
hefty spread.
yeah. But I mean, I don't think anybody's really trading this October
I was
contract. What will
yeah.
happen is you can look at this one. It has a lot more volume to it. See this open
Oh
interest?
yeah.
I mean,
That's a lot
or you
better.
can go out to November. Where's the November? Here's their November contract. You're going to have a lot of volume on that. They still like the monthlies on this, even though they have weeklies. And here's your December. This is your current one. It's going to have a whole lot more volume in all of them just because the December futures contract is front month. So people are
Oh yeah.
trading the December options on it.
Yeah.
So that's just how they are doing it.
And those spreads look so much better.
Oh yeah, because it's the monthly
Yeah.
and it's the December contract for, I mean, the December option for the December contract. So,
And those are liquid. Yeah, you can tell by the open interest. There's
oh
quite a
yeah,
few of those
you're
that
a
are
lot more liquid on
outstanding.
the, yeah, you're a lot more liquid on that. Now, if you're wanting to do premium, if you like to sell options, then these weekly ones are great to play with. I mean, you can sell premium in these things, but gold can move. You have to remember
Yeah,
that.
it
And another
can.
thing with options on futures, and I'll warn everybody about this. If you buy a call spread, and it kind of works the same way with an equity, but if you do like no next week's bull call spread in Tesla, and let's just, I mean, what was Tesla? Let's just do a 395 400, right?
I'm glad you're bringing this up because I had to help somebody the other day on the evening edge get out of a Tesla
Yeah.
bull or not a bull spread, but a bear spread that they accidentally entered.
Ah. So if I buy a 395 400 no bull call spread on Tesla, and let's just say today's Thursday and I did next week, right? Tomorrow we could be at 402 and they might be paying me 20 cents on it. And you're just like, I'm through the whole spread. They got the thing up. Why am I not getting paid on this? Well, the reason for that is you don't have any time decay on the short option. Okay. And until you start getting time decay on that short option and you have the intrinsic value on the long option and no time decay on the other one, you're not going to get paid. So the closer you get to expiration, the more decay you get, and you get paid a whole lot faster when that happens.
Right.
Futures, they don't do it that way, so to speak. You can literally sell a put spread that, I mean, if this was Monday and you sold the put spread in gold here and you brought in, let's just say you brought in 20 cents. What the heck? And you could get to Thursday and you could be way out of the money and you might be at maybe 3 or 4 cents on that thing. And you're like, how is that? We're so far out of the money on this. I ought to be getting, at least 50% of that thing that I've got, but they won't give it to you until like a day or two, like the day of expiration. They'll go, okay, well, but the thing is, futures contracts can move real fast and a long ways real fast. I mean, how many
They
times have you
can.
seen gold move like 70 bucks in a day?
A
Yeah,
lot.
a lot. So if I'm 50 bucks out of the money on this thing, they know news can come out and it can go right back down there and you could be totally screwed on your put spread, right? So that's why they don't pay you very quickly. You'll almost have to get to expiration before they pay you anything on those spreads. And unless they're, I mean, if you're in a bull call spread and you're $15 above your no your strikes, yeah, they'll start paying you money. I'll give you that one. But if you're four, three, $4, $5 above that, they know in 2 days that stock can be right back down where it was, just
That's right.
because of a bad CPI report or PPI or GDP or Trump said something or Powell said something. You have
That's
no
right.
idea, and it can be right back down to where it was. And so that's why they won't pay you for it, just because it can move just as fast up as it can down. So that's the thing that you run into. Outright calls and outright puts will pay you a lot faster because you have intrinsic value or you don't. There it is. But when you do spreads, that short option is the one that's going to kill you because they won't pay you for it. I mean, they'll sit there
Yeah.
and go, you need time decay for that thing to work. I mean, they'll pay you on the long call, but that short call is moving just as fast as that long call. And so if you're making $3 here and you're down $2.95 on this one, you're only up $5. And that's the thing you'll run into. So just beware of that.
Let's see. I'm trying to think. So, Jeff, I'm glad you're bringing up gold because this works perfect, in my opinion, because gold has just been on an absolute tear. And
Yes.
now we're consolidating higher. And it certainly seems like gold wants to take another leg up.
Well, yeah, it does. The problem that they ran into though is they went up and they hit 3,700. If you go back and look at century marks in gold, gold has a tendency to whack into those century marks and they'll back it up, 50, $60, which we did. We went up and hit, what was it, 37.12 or 13 or whatever it was, and they took this thing clear back to, what was that, 36.51 or 36.50 the other day or yesterday. So now they've corrected the thing $60, and now they kind of floated it up last night. The problem that you're going to run into going into next week, Fed day's coming up, right?
Mm-hmm.
So it's probably going to chill out a little bit up here at the highs until the Fed does its thing.
They need.
Once
It's really waiting on the rate decision, right?
Yeah. So once the Fed does the rate cut and they hear what Powell says, gold will start moving again. I mean, that's just the way it is. But
Yeah.
right
It
now, we're kind of waiting. I mean, even the S&P, even though it's making new all-time highs,
it's
it's
still.
they're still going to sit there and go, but what are they
Yeah.
going to say? Are they going to do another rate cut or not?
Yeah.
Because if they're going to do another rate cut, all the markets are going to take off and go. If they come back and go, well, this might be the only one for a while, then everything's going to sell off.
Yep. We're going
So
down.
that's what you got. But I mean, that's one thing that I like. I mean, I like trading gold, and I actually trade gold every week. And so, in fact, we have I think a little thing here that you can
We
bring
do.
up.
Yeah. I
And
can if you're ready.
yep, let's do that.
Let's do it.
and it'll kind of show you what I look for and how we trade that every week.
Absolutely. And you just broke down from a very fundamental standpoint too, how to do these spread trades. So that's
Yep.
even more helpful.
Yep. It is.
Well, all right, Geof, I'll kick this off, and folks stick around. If you guys have any questions, let me know. I can help you in the chat. But let me start this up.
Yep.